All right, welcome back to lecture 2 of the course. So this is where we'll begin to delve into the details. So last session, it was an introduction to the course and about all the things that we like to talk about. This is where we begin to talk about more of the technical details of the course. All right, so the first financial asset, remember financial assets are anything which is of value to begin with, it's an asset, and there is a claim for payment on someone, right? So the first thing that we'd like to talk about among financial assets as we build through the entire edifice of the financial system is to talk about money and the payment system in its simplest form, right? So what we'll try to do in this session is to basically talk about 5 key ideas, right? The first thing is to talk about why we need money in the modern economy in the first place. What is the role of money and why money was invented? So we'll talk about the inefficiencies of the barter system. Then we'll talk about what functions that anything that needs to serve as money needs to perform. What are the 4 key functions that we generally think about money? We can briefly touch upon why economists are skeptical that something like a cryptocurrency could be used as money. We'll talk about why that's the case. And we'll talk about how the payment system works, and then we'll start discussing some macroeconomic issues, right? About how the US money supply is measured and what the quantity theory of money has to say about money and inflation in the long run. Okay, money and prices in the long run. So that's the 5 key ideas that we'll discuss over the course of this particular session. All right. So as usual, let's begin with food for thought. My goal, at least in this course, is to connect it as much as possible with the real world implications and events of everything we're talking about here. So let's think about an issue that has come up in literature, in academic literature quite a bit, and it's also discussed in the financial press quite a bit. It's the issue that comes up often is that the Federal Reserve, as we discussed at the end of last week's lecture, took a lot of unprecedented steps, taking partial ownership stakes in publicly listed financial firms. It injected a lot of liquidity and into the financial system. It did a lot of what was called quantitative easing. And the question has always come up is whether the Federal Reserve is an instrument of the government of the day. Should monetary policy as administered by the central bank of a country be aligned with the political priorities of the administration of the day, or should it be independent? Right? In its original constitution, the Federal Reserve was designed to be an independent body. Even though the Fed chair is chosen by the president, the body itself operates largely autonomously. But the policy actions of 2007 2009 brought into this stark relief whether the Fed was truly acting independently or was it acting under political duress, right? So the question is, should a central bank even be independent of the rest of the government, or should it be somehow responsible for meeting the policy objectives of the government of its state? So that's what we'll try to answer over the course of this particular session. So, but before we get into all of that, let's talk about the invention of money briefly, right? So there's a wonderful book called The Ascent of Money by the British historian Niall Ferguson. It's also been made into a documentary. Uh, I'll try and find a link for it. I don't know if it's publicly available, but I'll try and find a link for it and post it if I can find it as well. Okay. But if you're interested in reading more about the invention of money in its current incarnation. But before we do all of that, we want to figure out what happens in the absence of money, and that's the notion about the barter system, right? So it seems obvious that we use money for a lot of transactions, but the question is not frivolous. It's not the frivolous question to us, do we even need money, right? Uh, Economies and trade and life in general function in medieval times and earlier without anything being used as money, right? And as we understand, money is anything that is generally accepted as a form of payment for goods and services or to discharge outstanding debts, right? Now, the question of why we need money begins with this notion of what happens if we don't have this notion of money in the economy, right? So economies don't need money to function, right? And in a nutshell, the barter system is a reasonable enough way for people to exchange. Trade does not require, right? Trade does not require that money exchange hands. Trade requires that goods exchange hands. As long as two parties who enter into a trade agree on the form of payment, that can basically be enough, right? So I have wheat, you have computers. I want computers, you want wheat. We can meet and then we can discuss the terms of the trade, right? I'll give you, I don't know, 2 tons of wheat for a computer, and if you agree on that, we have trade going on. We don't need any kind of money in order to facilitate those transactions, right? So that's the system that we call the barter system, where people exchange goods and services directly without some kind of intermediate medium of exchange, right? And that's basically what the system was in the early stages of the economy, right? And you can straight away imagine that the system is fairly inefficient. It works in a very limited way when you have like a small community and there's a few people who are participating in that community economy and they're trading with each other. In that context, it could work reasonably fluidly. But as economies grow in scale, the inefficiencies of the barter system are laid bare. And the biggest inefficiency is to think about what we already alluded to in the opening session about this notion of the double coincidence of wants, right? So the double coincidence of wants is this notion that for successful trade to happen, the counterparties need to have the object that the other party needs, right? If you and I have to trade, you need to have something I need to have something you need, and we need to agree on the right exchange ratio of those goods that we can both agree on and then be happy with it, right? That's this notion of double coincidence of wants. And the problem on relying on a barter system to facilitate all of this is this transaction cost, right? Transaction cost is all these other costs which are not related to the trade itself, but they influence the fluidity with which that trade happens, right? In order for the barter system to work efficiently, I need to go searching for counterparties who are willing to trade with me for the goods that I want and who also need the goods that I can provide, right? So transaction costs are all these other extraneous costs. One, I've already alluded to you in literature, there's the notion of search costs, right? There's particularly a big consideration in industrial organization and in labor economics, where when employers are trying to find employees to work for them, there are search costs involved. You need to go look for an employee who has the right skill set, who has the right temperament, who's willing to work at the wage rate that you're willing to offer. And all of this takes a bit of time and searching, and it incurs costs. You need to put out ads, you maybe hire a headhunter to do this for you, and all of those are costs that start to pile up fairly quickly, right? The second big problem is that each good has many prices. A good can have as many prices as there are goods in the economy. What does it mean, right? So suppose the only good I have to trade is wheat, but I want a wide array of goods. I want a computer, I want some other kinds of food. Maybe I need, you know, a phone, whatever it is. I need a bunch of different goods. So I go to each party who has this good. So I go to my neighbor who has a computer and is willing to sell it. I negotiate a price for it. So there is now a exchange of a computer for wheat. But at the same time, I'm going to exchange that wheat for something else, right? For let's say some other food stuff, for corn. So no good has a single price. Each good is expressed, the price of each good, in a certain sense. If you, this is very philosophically, intuitively correct way of thinking about what pricing is. Pricing is essentially a way of uh, figuring out what the exchange ratio between different goods need to be. So as many goods are there in the economy, we might have different, the price of the same good expressed in all these different terms, right? The price of wheat in terms of computers, the price of wheat and in the bales of corn, the price of wheat in the number of phones, and so on and so forth, right? So we can't, and then how do we translate these prices, right? And it becomes fairly complicated. How many computers is how many wheat, and how many wheat is how many um, uh, con, and then it becomes a big mess where you have all these multiple different prices floating around, and there's no harmonization among these prices. Okay? There is a lack of standardization which exists for goods and services. This goes along with this notion that each good has many prices. So there's no common way of determining value, right? There is no commonly agreed upon way of determining what the value of every good is, right? And finally, it becomes very difficult to accumulate wealth, right? So the crucial element of accumulating wealth is to have a lot of something, right? In this system of barter, you'll have some of everything, but not a lot of something. There is no way of building wealth. This is a constant trading procedure where we're trading off one for the other, but we're not really building wealth in any one particular commodity, right? We are just accepting different commodities and we're trading what we have, and we have like our wealth is distributed in small chunks among different commodities, and that might be a reasonable thing. It's a reasonably diversified way of distributing your wealth, this notion of where your wealth is held in many different commodities. But it's also very difficult to accumulate wealth. You can't really get a lot of one thing and then use that bulk of wealth in order to generate returns, right? So there are many problems, and these problems have been historically true in you go back to the history of economic thought, that these problems have been well studied, and that leads us to think about the invention of money, right? So the idea is that because every good can be expressed in many prices, the first iteration of thinking about money was to say, hey, why don't we agree upon a standardized form of payment, right? That's what a specific product, let's say it's a wheat based economy, everyone has a lot of wheat, and we agree that all transactions will be in the form of wheat, right? That payment will, a product, a commodity which has intrinsic value, which can be consumed and has value, will also stand in as a standardized form of payment, right? Yeah, all trade will be expressed in terms of units of this particular commodity, right? So we've already talked about it. This notion of commodity money is anything which acts as money, right? It has this function of being money to begin with, but it's also a commodity in the sense that it has intrinsic value, that you can treat it as just a commodity and just consume it and get some level of welfare from it. Or you could also use it as just a form of money. You just store it in a warehouse, and when you want to make payment, you just bring the wheat out and make that payment, and you go about your business. And straight away you can see that it makes uh, life a lot more easier over the traditional barter system, because all I need is a bunch of wheat, right? And then everyone in the economy accepts that as a form of payment, because they know that other people in this economy will also accept it as a form of payment, right? It's not that I want wheat, but I know that my neighbor will accept it as a form of payment, because he can take the wheat that I give him and use that wheat to trade it for something else he needs. And now straight away, some of the inefficiencies of the barter system are being overcome, right? So that's the first uh, iteration of thinking about money, is to have a specific product, a specific commodity to function not only as that commodity, but also as a form of payment, right? The bigger advantage of having this kind of money is that it allows people to specialize, right? So you don't have to worry. In a barter economy, you need to produce a wide array of goods and services in order to trade them, right? If you are only good at producing wheat, and the only good that you can produce is wheat, and not a lot of people want wheat because maybe they're also good at producing wheat and they don't care for exchanging their computer for bales of wheat, now you have a problem on your hands, right? So you have to produce the goods that the other person needs for trade to happen, and now you in economic theory, you want to leverage your competitive advantage as much as possible, right? If you're really good at producing one good relative to all the other people who you're going to trade with, then that's the good that you should be producing a lot of, and then use that to trade for all the other goods that you're not very good at producing, right? So what money allows us to do is, because there's a standardized form of payment, I can just go ahead and produce the good I want, right? I can just specialize and leverage my competitive advantage and produce the good I want, and then I take my good to the market, accept bales of wheat as a form of payment, and then I take this wheat and then exchange it for all the other goods that I want in the economy, and my life is much simpler. I don't have to produce some of all the goods that the economy needs to produce. I can go ahead and specialize in that one good that I'm really good at, right? So this notion of specialization occurring when individuals produce the goods for which they have relatively the best ability has the term comparative advantage, right? You'll see this a lot in trade theory where, when we talk about how economies choose which goods to trade with each other, the underlying framework of all of it is based on these notions of, comes from David Ricardo, who was an economist in the 1800s. He was also a minister. But anyway, David Ricardo came up with this notion of relative advantages and comparative advantages and absolute advantages as a form of basis for trading. Okay, so that's the first, straight away, the question of why we need money is that in the absence of money, we are reliant on a barter system which has major shortcomings, major inefficiencies, and we need money in order to begin to overcome some of these inefficiencies. And the first iteration of this was to use what we call commodity money. Okay. So, which takes us straight away into thinking about what functions does money need to perform, right? Generally speaking, we think of money performing four key functions. First, it needs to act as money, which is that the primary reason for why we need this money is that it needs to be accepted as a medium of exchange, right? That people will accept it as a form of common exchange between for goods and services in the economy. Right. The second thing is that it needs to be a unit of account, that we can essentially represent all these different exchanges of goods that are happening in a common uh, factor, right? In that there's a commonly accepted unit of accounting. So all the prices in the economy will be expressed in the form of that money, right? A computer will have a price. So if we accept wheat as the commodity money that we'll use in our economy, every single good in the economy can, the price of that good can be expressed in the form of units of wheat, right? A computer costs 1,000 bales of wheat, a phone costs 500 bales of wheat, a tap costs 2 bales of wheat, and so on and so forth. Now we have a unit of account, so we can keep track of how much economic activity is happening, because now we are able to measure it all in one common unit, and then we can add all of them up. Because the age-old adage of you can't compare apples and oranges comes from this idea, right? In order to compare apples and oranges, you need a common way of measuring the value of an apple, a common way of measuring the value of an orange, and then you can compare. Right? The third thing that is that it needs to be a store of value, that it holds its value, because you don't want to uh, accept something as money which will degrade. So you don't want any commodity which doesn't have a very significant shelf life, because you accept something as a form of payment, but if you have to immediately turn around and spend it, that's no good, right? You want to be able to store it for a while and then use it when you need it. So it needs to have this durability, that it doesn't degrade very quickly over time, that its value is held for at least a significant period of time, right? So you can think of bananas or like a vegetable or some kind of fresh produce. It is a commodity. You can get value from deriving it. You can accept it as a form of payment. But the big underlying problem with using something like that as a form of payment is that it's not durable, right? It degrades very quickly, and if it degrades very quickly, it doesn't have the store of value function that we would like to see in money. And then it offers a standard of deferred payment, right? That you can defer all these payments that are coming due. There is a standardized way of expressing prices in the future in the form of this money that we use. So those are the four key features that we want. Okay, maybe I want to say a little bit more on the standard of deferred payment. The point is that something which is accepted as money needs to be accepted sometime in the future, so that now we can represent the trade where you'll give me this good in 6 months time, and we agree on the price of that good today, in the form of this commodity money, right? That we can agree that this will act as money as a medium of exchange, and 6 months from now, so we can defer payments, and now we can put away, we can begin to leverage the time horizon, right? That we can begin to talk about trade not happening instantaneously. Straight away, we are thinking, you can think through as this option and calls and puts and all of this other things that we'll talk about inside financial markets are a form of deferred payment. These are claims which are deferred into the future, and you need a standardized way of representing those as well, right? So I have a few, you can think of everything here. So medium of exchange. So first, it needs to be accepted as a form of payment. It's a unit of account. It needs to be a way in which we can measure value in an economy in terms of this money. It needs to be a store of value. So it allows this to be stored for long periods of time that can be used to buy goods and services in the future. And it needs to be a standard of deferred payment. As a standard of deferred payment, it needs to be you can exchange these goods over time, right? Now, any asset, right? Any asset, for that matter, can be used as money as long as it has this uh, four key features, and the fifth feature is that it's divisible, that it can be turned into smaller units, right? They're like, in order to make sure that exchange rates can be a little bit more, you don't want everything to be determined in exact ratios, right? In the sense that it doesn't always have to be a whole number. So it's not like prices can't be like that, like a step function where it's like it's either $1 or it's either one gold coin or two gold coins. It's either one bale of wheat or two bales of wheat. You might want something in between as a price available as well, right? So it needs to also be divisible. So any asset is suitable to use as a medium of exchange if it has these five characteristics. First, it needs to be acceptable to most people, right? Nothing can serve as money if other people don't accept it as money. Then it doesn't make any sense, because you can't use it as money. It needs to be standardized in terms of quality. What we mean by that is that one unit of this needs to be similar to one unit of the other, because if there are variations in the medium of exchange itself, that throws a big wrench into the works right away. Because not only are we do we need to exchange goods and services which are different, now the medium in which we are exchanging, if suppose we use gold as a form of money, gold coins as a form of money, if one gold coin is somehow inferior to another gold coin, now we need to know what the exchange rate is between the superior gold coin and the inferior gold coin, even between this thing that we've already agreed as a medium of exchange. Now, if there's differences in the quality, if the of the what the medium of exchange, now we have a problem there as well. So it needs to be standardized in terms of quality, where one unit of this thing that we use as money is the same as another unit, what we call homogeneity. It needs to be durable. We've already talked about it. It needs to be valuable relative to its weight, right? Because that makes sure that it's easy to conduct transactions. Because if it's something like, something which you need a lot of for it to have some value, then yeah, it could act as money, but it's very cumbersome, right? If I have to airlift, like hundreds and hundreds of millions of tons of wheat for like 10 computers or something, that doesn't make much sense to me, right? Because yeah, it is money, it is acceptable, but like its value relative to its weight is very low. And then it needs to be divisible. We've already talked about it. If you think about it, the US paper currency, what we know as the dollar bill, the Federal Reserve notes, more technically, are something which meet all of these criteria. They're acceptable to most people. They're standardized in terms of quality. The notes are all the same, so you can exchange one note for the other. They're durable, because paper money doesn't degrade that much over time. It does. It slowly degrades over time, but it's durable for for long durations. Like you can keep a paper bill in your pocket or in your wallet for like a few years, and then decide to spend it one day and it's still fine. It's valuable relative to its weight. Paper is as light as a feather, and it can represent any value you want it to represent, right? A piece of paper can represent a value of $1, $100, $200, 1,000, whatever you want. Whatever denomination you want to print on it is what the value it will represent, and it's divisible, right? You can break it up into smaller units. Yeah. And that's the other kind of money that we talked about. The fiat money is money which has no intrinsic value. It is not a commodity. You can't consume this piece of paper for any reasonable purpose. All of its value comes from the fact that it's used as a form of currency, right? So people use fiat money generally as because it's designated as legal tender, because as the name suggests, fiat is a fancy way of just saying by decree, by order. It is this paper that we use as money is used as money not because it has some intrinsic value, not because it's some commodity that we can consume and get value out of. It's because it's decreed to be the to be the act as money, and nothing else is acceptable as a form of money, right? So legal tender is like as the government designation that this currency that this government is issuing is accepted for payment of taxes, and people must accept it for payment of debts, right? Now, as you can straight away see, this system is built on a notion of trust, right? The and when you see a lot of discussion in the current climate around cryptocurrencies, around Bitcoin, Ethereum, whatever, you have all these different currencies which claim to act as a form of money, as a medium. We'll talk about what the problem could be, but they claim to act as some kind of money. And the problem here is that you need to have the trust in the system that it's well managed, that other people will accept it as a form of payment. If nothing else, if no one else in this economy will accept it as a form of payment, you could always show up at the Federal Reserve and they will have to honor that debt, right? Like, because if you think about what a paper currency is representing, it's a financial claim, right? It seems kind of strange to think about this, that what you trade when you make a payment with a piece of paper that we call a dollar bill, what you're trading is a financial contract, right? I mean, when we think about trading financial contracts, we think of it in some very complicated, happening by very sophisticated people trading on some, large sums of money. But here it is. Every single person in the economy, in a certain sense, is trading a financial contract, because anyone who holds that piece of paper is entitled to receive goods and services which are represented by the value of that paper. That's what a financial contract is. There is a claim of payment on somebody else when that piece of paper is presented, an IOU. Okay. So in a certain sense, that's what's happening, that this financial contract, for this system to work where people are trading financial contracts with each other constantly, there needs to be an element of trust in the system, that the system is well managed and so on and so on. Okay. All right. So now we'll turn quickly to talk about the payment system before we'll delve into the money supply and then the quantity theory of money. Okay. Okay. So a payment system, very simply, is some kind of mechanism, some kind of institutional mechanism that we put in place for conducting transactions in the economy. Okay. Now, the transition from commodity money to fiat money is interesting. Okay? So the first iteration was to use some metal, which was valuable. Now, the advantage of using a metal is that first, you can, it is very durable, that it lasts for long periods of time, so it meets that criteria. The other criteria is that it can be standardized, so you can essentially set up a mint where they print, where they make these coins, or gold or silver coins, which were what were used generally in the history of invention of money, where you could print the same kind of coin over and over again, and then on the coin you would imprint some kind of a, some way of making sure that it's not counterfeited, so there is a royal imprint on the coin, and then the coin which has that royal imprint. So not all gold coins will be accepted as money. Only gold coins which have that imprint on them, which by decree, by government order or decree, is mandated to be used as money, is what gets used. Right? So the transition is fairly straightforward. For a long period of time, gold and silver coins were what were used as money because they met all the criteria of acting as money. They acted as a medium of exchange, a store of value, a form of deferred payment, and they were durable. Now the problem with it is that gold and silver coins, they're metals, they get very heavy, and it's really cumbersome to carry around piles of gold coins in order to conduct small transactions, right? Or even large transactions, especially if you want to go buy a piece of land like 50 acres of land and you need, I don't know, 200,000 gold coins for it or something. It is going to, it's a lot of gold to just carry around. You need to transport it and make sure that it's secure during transportation, then do all of this, and it adds a lot of other headaches to the transactions. So what early banks decided to do was that, okay, what we'll do is that keep all of this gold and silver safe in our bank. Instead, we'll issue you a note, right? And issue you a note which says that this account has this much gold in it, and you can, if you have this, if you have this piece of paper, you can show up to our bank, and if you present this paper, we will release that amount of gold to you, to your account. So we can move it from one account to the other account, and we don't have to move gold over vast distances. We don't have to airlift gold from one country to the other. We just take gold from one account and move it into another account as these pieces of paper are traded, right? This is the invention of paper currency, right? So where you store all of this, whatever the commodity itself, which was used as money, is stored in a safe place, and instead these pieces of paper are issued representing the value of that underlying commodity which is stored. Okay? Now, for the longest time, in the US, up until 1973, the US stayed on what was called the gold standard, right? The idea here is that that piece of paper that we call the dollar bill was backed by its equivalent amount in gold, right? So technically speaking, you could take that piece of paper to the bank and say, I don't want this piece of paper anymore. I want the gold value, the value of gold which is attached to this piece of paper. Okay, this is where we have what we call a pegged currency, a currency which is pegged to some underlying currency, or a backed currency, right? That's this notion of a gold backed currency, a gold standard, a silver standard, a sterling standard is what UK had adopted for a long time, where sterling silver was what was used as the backing commodity for these paper currencies. But over time, people have enough trust in the Federal Reserve. As trust builds up in the system, you don't need to back your currency with anything else, right? Today, the central bank issues paper currency, but it is not backed by any underlying commodity. You can't go to the bank and be like, okay, here's $100 bill, give me gold for it. That doesn't happen anymore. In 1973, basically the US was taken off the gold standard, and from then on, the paper currency just existed um, as we know it in its current form, without being backed by any other commodity, right? So that's the invention. These pieces of paper that we have now is the basis of the invention of what we call the check, right? And the checking account and the checkbook, because what you're writing out are financial contracts. When you sign your name, when you mail your rent check to your landlord for wherever you're living, and you write on the, where you say, you date it, and you write the pay to the order of, and then what account it needs to go into and the amount. This is a financial contract, right? Because what you're saying is that I am entering into a financial contract which is going to be facilitated by a bank as the intermediary, where I am going to turn over this amount of money from my account to my landlord, or and when this landlord presents this piece of paper to the bank, I authorize the bank to release those funds to the landlord, right? And it's, and that's what I want to emphasize, is that everything complicated in the world needs to start off as a simple thing, right? So once we go through this course, the point is that, we might look at different kinds of financial contracts, and the modern finance is very complicated and very, very hairy. But if you understand the basic idea of what it is that's happening, right, and from that vantage, if you start to build up the level of complexity, things become much simpler, right? If you begin to think of check, if you just stop for a second and think about what that check is, it's a financial instrument, it's a financial contract. A lot of, in that 3 lines of that paper, where it's in its current form, you are conveying a lot of information. And that is, straight away you can see that, okay, if this is the basis of a financial contract, where the two parties need to be listed, the trade amount needs to be listed, a duration needs to be agreed upon, and then some kind of remedy, right? So if this piece of paper is shown and that money is not received, what happens then? And now you have all the elements of a financial contract. Who's the trading partners? What is the thing that is being traded? What is the value of the thing that is being traded? When will it be delivered? And what happens if any of these provisions are broken? And now you have the elements of financial contract. So the next time you write a check, I don't know how many of you write a check anymore. I mean, I haven't written a check in years either. But when you stop to think about it for a second, that should give you an inclination of what a financial contract would look like, right? It's a very simple financial contract, but straight away you know what the basic elements of financial contract need to be. Okay. All right. So now we'll turn into talking about a couple of key macro ideas about money, and that's where we'll end the session, right? The first thing is to think about how the US money supply is measured. Now that we know that in the US, the dollar bill is what we call what is generally accepted as a form of legal tender. It is what we call money. How do we measure how much of this US money supply? What counts as money, right? And so macroeconomists have come up with a lot of different measures. So if you pick up a copy of the Wall Street Journal, you go online or wherever, every morning they print how much money supply there is in the US. And you will see this in almost every country. At some point, some page in the newspaper that you get, they're going to print how much money supply there is in the US, right? So there are many different measures depending on what kind of thing interests you, what it is about the money supply that you would like to measure interests you. You can come up with many different measures, and there is a lot of different measures in the US. There's what we call M1, M2, M3, M4, and it keeps going. But the most common ones, the most common definitions that we think about when we measure the US money supply is M1 or M2, right? M1 is a very narrow definition of what is considered to be money supply, right? So it's the sum of the currency in circulation, all the dollar bills that are in circulation, because that's just money, you're counting that. You don't stop there. You count up all the deposits that there are in checking accounts, because the idea of a checking account is that people hold cash that they need to facilitate day-to-day transactions in their checking accounts, right? Any excess cash is put away, if you're reasonable, put away in investments or savings accounts, or you do something more productive with cash that you don't need immediate access to. So the amount of money which is lying in the checking account is not exactly in the form of dollar bills. It's still a number on a screen or in your app, but it's still money which is circulating, which is going to circulate very quickly inside the economy. And then there's the traveler's checks, right? Like when people travel, again, this is a very liquid form of money where you get a traveler's check and you can use it as a form of payment when you're traveling from country to country, and that's very liquid as well. So M1 is a very narrow definition, right? It just takes into the aggregates the total amount of currency there is in circulation, everything that there is in the checking account, all the sum of all deposits and checking account deposits in the country, and anything which is held in the form of traveler's checks. right? M2, on the other hand, is a slightly broader definition of money supply, right? So it includes everything which is part of M1. So everything, currency in circulation, checking account deposits, holders of and travelers checks. And then it adds in other things that could be thought of as money as well. Okay? For instance, time deposits under $100,000, right? So a time deposit is like a certificate of deposit where you essentially give your money over and that money is locked in for that period of time and earns a slightly higher interest rate than what a savings account would give you. But that's, the argument here is that that is fairly liquid, that money can be used at any point in time. You can take your money out of that certificate of deposit. Most certificates of deposits these days don't have any pre withdrawal penalties before that period has ended. You can do that, but some will carry a small penalty for early withdrawals. But again, it's very liquid. You can straight away take that money and use it as a form of payment. So the argument is that maybe that needs to be included as part of money. Same argument from savings accounts. That savings account, this is money which is just sitting in a different account than a checking account. Notionally speaking, this is money which is not immediately earmarked for consumption or for some kind of trading activity right away, but it's very liquid. You can use it as easily as you would use the money in your checking account. So the argument is that maybe that we need to use it in the measure, we need to account for it in the measure of money. Money market deposit account, so anything which is in institute and money market, and then mutual fund shares, money market mutual fund shares, all of these things where you're buying currencies and whatnot. So maybe we need to include that in the form of money. So here's a quick thing. So this is again from the Fed. So a lot of this is, or a lot of the data that we'll use, or all these graphs that we're using is coming from the Fed. And Fed has a very, very nice database, a website called the FRED, which is managed by the Federal Reserve System. And the FRED essentially is where you can find all of this data on money supply, currencies, and a lot of very interesting data gets put out by the FRED. So, and it's all of it is publicly accessible. So this is data from the FRED, and you can see what it looks like, right? We use the measure of money supply as just being M1, which means currency, checking account deposits, and travelers checks. Now that between that, it's about $3.2 trillion. This is about 2016. It's gone up a little bit since then. So about $3.2 trillion worth of what we call M1 money is in circulation. So of that, 1.3 trillion is in the form of currency notes, checking account deposits of about 1.8 trillion, and then just 2.4 billion in travelers checks. So, travelers checks, even though we include it's just a very, very tiny sliver. So it's basically everything which is in currency and checking accounts. That's what forms the M1 measure. M2 measure is a much broader measure. So it includes everything in M1. So all of this entire thing becomes a sector here. So that's about 3.2 trillion. And then we also add in savings deposits, which is about $8.3 trillion more. And then money market, small time deposits and money market mutual fund shares, those account for the other constituents. Okay. Right. Here's the quick thing that I want to emphasize. This is much more about much more of interest to people who are interested in more research topics in this area, is that what does the level of M1 and M2 look like, and what are the long term time series dynamics of these two measures, right? So M1, if you look at it, it's fairly stable. It moves slightly, slowly it moves, and then suddenly there's this big, relative to the historical long run average, this is a big increase, right? So a lot of commentators, right, a lot of people who watch the Fed watchers as we call them, claim that in the aftermath of the 2007-2009 crisis, the Fed really expanded the money supply in the US. And we'll talk about what happens if there is a massive increase in the money supply. But here you can see that, yes, if you look at the M1 measure, there's there's an increase. Relative to the historical average, there's no arguing that there's been an increase in the M1 measure. But what's more dramatic is this, if you take the broader definition of money in the US, this is concerning, that M2, the broader measure, which includes savings deposits and money market mutual fund shares and all of that, it has risen remarkably, right? Like if you look at the slope here is fairly flat, and then since about 1996, 1997, you see this big expansion in it, right? The other thing is about that this is essentially tracking the slopes of these lines. So when we're talking about the growth rates of M1 or M2, we're tracking the slope of these lines, and you can see that M1 is in the faded green and M2 is in the dark green. And you can see that the growth rate in M1 is much more steady. There's spikes here and there, but it's much more steadier than what we see in M2, right? But you can see the big spike in M1 comes in 2007, 2009, and there's another big spike in 2012, 2013. But what we have is that M1 has much more instability than has M2, right? If you see these spikes uh, here, if so this is very informal way of saying this. How you measure this is to look at this standard deviation or variance. These are statistical ways of measuring deviations from historical average, and that tells you how much what we call volatility there is in the measure, right? So if you hear the word volatility in financial markets, what it's measuring is just basically standard deviations and variances. But if you look at this M1 or M2, so if you try, okay, if you try to fit a line through it, let's say some line which represents the long run average, and uh, if these spikes are very far from that long run average, that indicates that there's more volatility. Okay, so if you look at the dark green line, if this is the long run average, I just drew a line like that. So suppose that's a long run average. You see that M2 basically fluctuates fairly closely. There are spikes here and there, but M2 is much less volatile than M1 is. M1 as a measure is much more volatile. So the point is that why do we have all these competing definitions of how we measure money supply, is that it depends on what you want, right? M1 is a much narrower definition, so that's good, but it's also a much more volatile measure of money supply, so that's not so great. M2 is a much broader definition of money supply, which is, you can begin to nitpick and say, is that money? No, should we use that? Should it be under $100,000? Should be under 50,000? Should it be 2-year maturity, 1-year maturity? You can make a lot of quibbling arguments here, but M2 is a more stable measure of the money supply. And for some research purposes, maybe you want to use M1. Some research purposes you want to use M2. It depends on what the purpose is. Okay, so that's the reason why different people have come up with all these different measures. It's come out of academic literature where people have noticed these patterns and decided that maybe we need to expand the definitions or use alternative measures of money supply in our research. Okay, all right. So finally in this session, we'll talk about this very interesting theory, what we call the quantity theory of money, and how it informs a very simple theory of money, informs what happens, what is the relationship between money supply and prices in the long run. Okay. All right, so let's look at the quantity theory of money now. So with the quantity theory of money, the idea emerges from Irving Fisher, right? Uh, I guess I can betray my own biases here. I'm a huge admirer of Irving Fisher. He wrote a lot of very influential papers in the early part of the 20th century. So between 1910 and 1925, his research output in economic to contributions to economic literature was enormous. But a lot of his reputation has kind of been tarnished, dissipated, and it's been revived because he was very invested in the stock market. He was very bullish on the stock market. And in October 1929, when the stock market crashed and the Great Depression set in, he lost a lot of money. And with it, money and credibility go in hand sometimes, and with that, a lot of people discounted many of his views on what he had to say about the economy, because they're like, okay, what does this guy know about the economy if he has lost so much money in the stock market? Reasonable, but its contributions to theoretical discussions in economics and more practically what we are seeing in the data today are enormous, right? So if you're interested, there's a wonderful book called The Worldly Philosophers. It's written by a professor at Princeton, Robert Heilbronner. And the book has these vignettes, right? So each chapter is devoted to an economist. So if you're particularly interested in economics and the history of economic thought, it's a very nice introduction to the history of economic thought. So every chapter of the book picks up one economist, traces their life arc and also the ideas that they had and how they contributed and how they moved the ball forward on our thinking in economics, right? So it starts with Adam Smith, David Ricardo, and so on, and it moves, and there's a very nice chapter on Irving Fisher in that book. But the quantity theory of money comes up from Irving Fisher's idea, okay? And it's a very simple idea in its core. All right. There's four key elements of this equation that we've written here. This is the quantity equation that we've written here. So the idea came from this notion. So why here? Let's talk about each of these elements in turn. Why here is the real GDP. Okay, the real GDP is, as a measure, is measuring the total quantity of goods and services being produced in an economy. Right, it's the total aggregate of all the quantities of goods and economies, services produced in the economy. P here is the prices of all of these goods and services. So even though we are writing it as PY, it's basically two vectors. So you can think of it as a vector of prices. So there is all these prices for all these different goods and services which are being produced, times a vector of all these quantities of these goods and services which are being produced. So price times quantity, the price level times the real GDP here tells us the nominal GDP. The nominal GDP tells us the dollar value, the dollar denominated value of all the goods and services being produced in the economy. Very simple, right? So quantity times price tells us the dollar value of that good, right? Now the idea was that, okay, so this tells us the dollar value of the economy, of the economy. So Irving Fisher's entire thing was that the money supply, M here, which represents the money supply, needs to be proportional, right? It needs to be directly proportional to the nominal GDP PY, right? Sorry, I'm writing with my trackpad, so it's a little bit, messy, but that's the key insight. He says, okay, this is the dollar value of the size of the economy, then the money supply needs to be proportional to it. So if it's a large dollar value economy or a large currency denominated value, whatever the currency is, so we'll just stick with the dollar and keep it simple. So if the economy is very large, the money supply which is required to service all the transactions that happen inside the economy needs to be directly proportional to the dollar value size of the economy. So the key insight of this quantity theory of money is the fact that the money supply is directly proportional to the nominal GDP. Now, with proportionality, if you know your proportions, and I'm hoping you all do, you've seen proportions and fractions and all of this, the way we convert proportions into fractions is to say, okay, if M is directly proportional to the nominal GDP, then M is some multiple of this nominal GDP. And that's where this equation comes from. M times V is equal to P times Y. Okay. This V is what we call the velocity of money. Okay, so if we rearrange this equation, so V is just Py over M, right? So V is Py over M, and what this says is that this is the number of transactions, the average number of transactions that a unit of currency participates in. Because if this is Py represents the dollar value of the economy, the size of the economy, M is the value of the money supply. So one unit of money participates in these many transactions, and that's what the average unit of money participates in so many transactions, and that's what Irving Fisher called the velocity of money. Okay, Now, Irving Fisher asserted when he came up with this theory that velocity of money is constant. Okay, and then it became a identity, right? If V here doesn't move around, V doesn't move around, then M needs to move in order to compensate for any change in P or any change in Y. Okay, so what does it mean? If V here is a constant and Y goes up by 10%, the real GDP goes up by 10%, money supply needs to go up by 10% as well for this equation to hold. Same thing. If prices go up by 10%, if the price of the goods and services are being traded in the economy are rising by 10%, then you need 10% more money supply in order for this identity to hold, right? And straight away, this gives us a nice, clean equation which tells us what the relationship between money and prices are. Okay, once you assume that the velocity of money is constant, and a quick note here, empirically, that's what we observe. So let me just make that clear, that empirically, when we look at the velocity of money, it's not a perfect constant. It's not the same all the time. It fluctuates, but the deviations are very minor, that the long run, it looks like it's constant, right? In the very long run, the velocity of money is constant. Okay. So when we take that quantity equation and express it in percentage changes, what we have is that the percentage change in M plus the percentage change in V should be equal to the percentage change in P plus the percentage change in Y. Okay. Now, the argument here is that if this percentage change in V is going to be 0, if V is a constant, then it's not changing. So percentage change in V is going to be constant. Then the percentage change in prices needs to be equal to the percentage change in M, in the money supply, minus the percentage change in Y, minus the percentage change in real GDP. Okay, this is what we call the inflation rate, right? How inflation rate is telling us how prices are changing. What is the percentage change in the price level? We'll talk about how these prices are measured in a later discussion. We use what is known as a consumer price index or a personal consumption index. There's a lot of these different measures through which we can measure prices, but the theoretical argument is very sound. It says that inflation rate, the percentage change in prices, is going to be the percentage change in the money supply minus the percentage change in the real GDP. And it's a very crucial insight, right? So in a different way, right? If I read it just this way, if the percentage change in V here is 0, suppose this goes away, then the percentage change in M could be because of for two reasons: percentage change in P or percentage change in Y. If it's because of percentage change in Y, that's completely okay, because the economy is getting larger, the number of goods and services that are being produced, the real GDP, right? Y here is the real GDP, the number of goods and services, units of goods and services being produced in the economy, it's getting larger. And that's why we have larger money supply. And that's amazing, right? That's what we want. Okay, larger money supply to facilitate trade in a larger economy, which is producing more goods and services. But if this money supply is changed, if there's more money supply, then there is the change in the quantity of goods and services. The rest of it is carried over in the prices, right? If there's a lot more money, the argument here, I think, should be intuitively simple. If there is more money than what is required to service the transactions in the economy, what happens is that the price of each unit of that money is falling, right? You need more and more units of that money. The value, I should say, not the price, the value of each unit of that currency is falling, which is to say you need more and more units of that currency in order to get the same basket of goods and services. And that's what we call the inflation rate. Okay, and it's a very simple idea. So it starts from this, Irving Fisher starts from a very simple framework, that the size of the economy, the dollar denominator size of the economy, the nominal GDP needs, and the money supply need to be proportional to each other. To turn the proportionality into an equation, we introduce a proportionality constant that we call the velocity of money. Now, once you assert that the velocity of money is constant, now the inflation rate in the economy is basically determined by the difference between the percentage change in the money supply and the percentage change in the real GDP, in the total quantity of goods and services which are being produced in the economy. Okay. And here we have a panel which shows us this relationship between, where we are standardizing it as M2 growth. So we are using the most stable definition of money supply and inflation. So on the x-axis here, this is for the United States. We're measuring M2 growth and the corresponding inflation rate. And you can begin to see that it's not exactly one-to-one, but there is a, if I try to fit like a gentle line through this data like that, you can see that there is a positive relationship between money growth and inflation rate. The faster the growth rate in money, the higher the inflation rate is going to be, the faster the change in prices, right? So periods where you see extraordinary increases in the money supply are periods which are often going to be accompanied by very high run up in the price levels, right? Prices go up. Now, the point is that needs to be relative to the size of the GDP. So if the money supply is growing, right, if the money supply grows at the same rate in which the real GDP is growing, there's no effect on the inflation rate. That's completely fine, right? Money supply, the change in the money supply cancels out the change in the real GDP, and then the inflation rate is zero, which is to say prices are constant, they're stable and constant. Now, if the money supply changes a little bit more than what the change in the real GDP is, then we have inflation. And so, and the corollary idea here is what we call deflation, where the change in the money supply is less than the change in real GDP, in which case you have negative inflation, or what we call a deflation. Okay. Now, this is just for the US, and we see that this is much more nicely represented here when we look at the relationship for different countries, right? So we are looking at the growth rate of M1 and inflation around the world. So these are countries like, so the way to read this graph is that this is Ukraine. Ukraine has M2 growth rate of about, let's say, 24%, but it's also accompanied by high inflation rate of about 14%. So what does that tell you? From that, you can back out what the growth rate in real GDP is. What's the growth rate in real GDP? So if the money supply went up by 24% and prices went up by 14%, then the growth rate in the real GDP is the remainder, which is 11%. Okay, money supply in this economy was growing at a much faster rate than the real GDP. If you're going to apply Irving Fisher's quantity theory of money, that's what that should tell. And you once again see this upward sloping line. If I try to fit a line through all these data points, regression line, a line of best fit through those points, then I'm going to have this upward sloping feature to it as well, which suggests that the faster money supply grows relative to the growth rate in the economy, in the real GDP of the economy, the faster the inflation rate grows, the faster the prices go up. Okay. So the question is, how accurate is this? Can this be directly employed? We have suggestive evidence here that Irving Fisher seemed to be right about this relationship between money supply and nominal GDP. Now the question is, how reliable is it to use this in a day-to-day practice, right? Now the one key issue to understand here is that the velocity of money, that in the quantity theory of money that Fisher asserts to be constant, is not so in the short run. Okay, so in the short run, velocity is erratic. So if you're going to do short run economic analysis, then this is not the right framework to employ, because you can't assume that V in MV equal to PY, that V is going to be constant. This is not true. In the short run, there's fluctuations, and those fluctuations are large enough in the short run that there's no way in which we can reasonably assert that it's a constant in the short run. So for short-run forecasts of inflation, we can't really employ this all that well. But if you're going to do long run economic analysis, then in the long run, the velocity is constant, right? Even though there's short run erratic fluctuations in the velocity of money, if you take the long run time series average of all of that, it turns out that it's constant over time, okay? Or relatively constant, moves around even in the long run, but it's not that bad of an approximation to say it's constant, okay? So what is the problem with prices going up? Okay, what is the problem with prices going up? Prices going up a little bit is not too much of a issue, right? So if you look at the Federal Reserve policy in the US, and that's changed actually uh, in the last couple of weeks, if you're following the news, that the Fed revised what they were going to do with inflation. But since at least 1991, the Fed has adopted this 2% benchmark, right? That they want to target an inflation rate roughly about 2% a year, and they don't want inflation rates higher than that. So if you look at the history this uh, of this issue, in the 1970s in the United States, there was a period of very high inflation. Okay, so very high inflation rates were the norm. And if you have very high inflation, what it means is that the value of money is getting degraded very rapidly, which means that if prices go up a lot, right? Intuitively, just tell yourself a story. If the price goes up, what does it mean? It means that I need to give up more dollar bills in order to buy that same good that I was going to buy yesterday. So if yesterday I went into the supermarket and the good was priced at $100, right? Now I go back to the supermarket today, and instead of that price being $100, it's not $110, right? So in order, the good itself has not changed. That's the key insight. As a good itself is the exact same good as it was yesterday. But the problem now is that instead of giving up $100 bills, I give up $110 bills. So the value of each of those dollar bills that I have is now lower, right? And that's the problem with prices changing too rapidly. So in the United States in the 1970s, there was a big run up in inflation, and Paul Volcker, one of the most influential Federal Reserve chairmen, was appointed by Jimmy Carter's administration, continued through Reagan's administration. The first part of the Reagan administration was brought in to tame inflation. And so when he came in, he looked around, and what did he do? If this theory holds, and the problem here is that the inflation rate is running up, you want to bring this inflation rate down. Okay? What do you need to do? You need to drop the money supply, right? Straightforward. If you start from that equation, it tells you that, okay, I want this number to fall, the inflation rate to fall. Then if I want this inflation rate to fall, what do? I bring down the money supply. If I bring down the money supply, what happens? Credit markets tighten, there's less money supply, right? And that puts a big crimp in the economy, because what you have as a consequence is that there's less credit, there's less money supply which is available, which means credit becomes tightened, which means that people who need to access credit are faced with higher interest rates, and then there are all these ripple effects. So if you're an entrepreneur with an idea and you want to get a loan to get your idea off the ground, now the cost of that loan has gone up because there's lower money supply. We'll get into all of those technical details of how money supply influences the interest rate, but I just want to give you a quick indication of what happens if you have a high run up in inflation and you try to tackle it by dropping the money supply drastically, which is what Volcker did in the early part of the 1980s, where he cut the money supply dramatically. The inflation rate fell dramatically, but the economy also slowed down quite significantly because there was less credit available in the market, which meant that new business creation was much slower and unemployment began to surge. So now you have like this trade-off, right? If you're familiar with this idea, this is what's known as the Phillips curve idea, that inflation and unemployment move in opposite directions. So if you try to bring down an inflation rate by cutting the money supply and tightening credit, unemployment will surge. If you try to bring down the unemployment level by increasing the amount of credit there is in the economy, inflation will surge. We'll talk about Phillips curve in a few sessions, but it's important to keep that idea. If you've not seen it earlier in an intermediate or an intro class in economics, now you know what the uh, interaction is between the inflation rate and the real economy. Okay. Anyway, so hyperinflation, right? So inflation, which is completely out of hand, is what we call a hyperinflation, where you have more price rises of more than 50% per month, right? So the most recent example of a massive hyperinflationary spiral is what we saw in Zimbabwe in 2008, where the inflation rate was 15, not 15%, which is a high inflation rate to begin with, not a 1500%, which is unimaginable, but 15 billion percent. Okay. So there are many examples of hyperinflationary episodes in economic history. So if you turn back the history books, and I mean, I'm particularly fond of World War history, Germany in the 1920s. Okay. Germany in the 1920s, if you look at the history of what happened, so uh, in the aftermath of the First World War, Germany, the victors, the Allied powers, basically, they entered into the Treaty of Versailles, and Germany was held responsible for the outbreak of the First World War, and they were ordered to make all these payments to all these other countries which they had affected by invading them and destroying them and all of that. And Germany was starting to make these payments, right? But now the German economy was war ravaged, right? It had also been destroyed and they were rebuilding. So its economic capacity was significantly diminished and these reparations were quite significant. So now the German government decided, okay, so if you have control over the printing press, so, okay, so the Treaty of Versailles says we need to pay back so many Deutschmarks, right? So that was the currency, so many Deutschmarks every month or every quarter or every year. So, okay, one way to pay that is that we produce whatever we produce in the economy, a portion of it goes to make those reparations. What Germany decided to do was, after making these payments and starting to become very cumbersome on the government to make these payments, they just started printing more money, because you're like, okay, you need 150 million Deutschmarks as payment. I'll just print 150 million and give it to you. What they're doing here is rapidly increasing the money supply. And what Fisher's quantity theory of money tells you is that if you increase the money supply such a fast rate, and when your economy is not growing, the real GDP is not growing at that clip, what you will have is a huge upsurge in prices. Because if you have a lot more currency which is floating around, it's simple supply and demand. If there's more currency, the value of each unit of that currency is lower, which means prices are higher, which means you need more and more units of that currency whose value is now lower to buy the same basket of goods and services. And that's the intuitive logic of it. And Germany entered into a hyperinflationary spiral in the 1920s, and that, if you know your history, that was used. There was a lot of distress in the German economy. That was used by Hitler and the National Socialists to basically point to the Treaty of Versailles and how unfair it was, and then he came to power that way, right? So sometimes hyperinflationary cycles can result in some massive political consequences, and that's as stark as a reminder as you need as to why people care about hyperinflation. Similar problems in Argentina. Argentina is the problem child of the world economy. It has received, I think, something like 9 IMF bailouts in the last 30 years, but they keep doing this over and over again. They keep entering these hyperinflationary spirals and then gets out of control. Same thing in the Zimbabwe in 2008. Robert Mugabe's government again did a similar thing where they just printed a lot of money to finance all these foreign transactions and then entered a very, very, very significant hyperinflationary spiral, right? So what happens in a hyperinflationary spiral, that the prices are rising so much each day and so rapidly that money purchases fewer and fewer goods each day, right? And after a certain point, if you have too much inflation, that degrades anything about this currency, right? I mean, one day, that currency can buy 20 apples, The next day you go to the store and the store says that note is only worth 10 apples, and the following day they say it's worth only 1 apple. Who wants these notes anymore? And that's the crisis of confidence in the currency, right? There's a currency crisis, and households and firms respond by refusing to accept it as money, right? Because it's not holding its value at all. Every day its value is getting degraded a lot. Households and firms refuse to accept money, and then straight away it puts a huge crimp, where now you remove the medium of exchange. The medium of exchange function has gone away. What do people do? They go back to barter, and that's what you find, right? Where, or you go to some other currency, right? Either you move to some other currency, which is what Zimbabwe did. The transactions were only conducted in dollars. The government didn't like it, so they started cracking down, and then there was a huge black market which opened up, which where they were accepting dollars or other foreign currencies as a form of payment. And then people who couldn't access these black markets, what are you left with? You're back to good old barter. You take what you have in your house, you go and try to exchange it for what you need, and it's a massive crisis that you have on your hands, right? So the quantity theory of money then, knowing that these devastating consequences of hyperinflation can occur, what the quantity theory of money tells us is that hyperinflation is basically caused when the growth rate in the money supply outstrips the growth rate in the real GDP, right? As soon as the money supply is rising more rapidly than real output, you have a problem on your hands. And then the question then becomes, why do central banks allow money supply to rise, right? Now, as I talked about with the case with Germany in the 1920s, as we talked about in Zimbabwe in 2008, the argument or the intuitive explanation is fairly straightforward, okay? You are a government in charge, okay? Now the people depend on this government to provide all these different services and whatnot, and the government finances all these provisioning of all these public services by collecting taxes, okay? Now if you're a profligate government and you spend a lot more than what you're collecting in tax revenues, you have a budget deficit on your hands, right? You're spending more money than you're taking in. What are your options now? Three options present themselves. First, you cut back on how much spending you're doing, because your tax revenue, your tax base is not enough for you to spend at the rate you're doing. So cut back on spending. No one wants to do that. Political consequences are paramount. You start cutting back on vital social services and public services. People are going to get very angry and they're going to vote you out, and you're going to lose power, and that you don't want to do. Okay. So you don't want to cut back spending. You don't want to do what we call austerity in current days. Second option, okay, spending is outstripping tax revenues. Maybe I can raise taxes. Again, that's going to be very unpopular. No one wants to pay more in taxes. Again, you might have political consequences. What's the third avenue that you could think of? Okay, I want to spend more money. Why don't I make more money? Why don't I just print more money? And as soon as I have more money, I can spend it. You can get away with it for short durations. In periods of extreme economic duress or crisis, like in the 2007-2009 crisis, like we are seeing right now with the Fed's interventionist policies during the coronavirus epidemic, you can get away with it in the short run, but you can't keep it up with the long run, right? If you keep doing that over and over again in the long run, right, you flood the dynamics are very straightforward. You increase the money supply rapidly today, right? That's what the Fed is doing right now. It's increasing the money supply rapidly today. What does it translate into? That's cheaper credit, right? There's more money supply, so there's cheaper credit which is available, which means that people will use this money in order to start new businesses, invest in their existing business, whatever, consume more. If people consume more or invest in new businesses, what happens? The size of the real economy starts to grow. So now that money supply growth rate, the rapid increase in the money supply growth rate can be begin to get offset by the increase in the real GDP. And so in the short run, you can increase the money supply rapidly as long as there's a nice little response from the real GDP, that the goods and services being produced in the economy are going up. Now the inflation rate remains in check. But if that gets decoupled, which is to say, if you keep increasing the money supply over and over again, rapidly over and over again, then the economy can't grow at such a fast clip for such long sustained periods of time, and you're going to enter into a hyperinflationary spiral. Okay, and that takes us, I have the thing here about Germany. So hyperinflation in the 1920s. So the total number of German marks in circulation, as you can tell, uh, went from 115 million in January 1922 to 1.3 billion, right? That's like a tenfold increase in the money supply in 2 years, right? And then to 497 billion by 1923, right? So you can see what is happening here. And as you can say, the price index really began to climb up. Okay, so these are the problems with hyperinflation, and governments, as we said, have an incentive, to print more money because it's the least politically inconvenient and the most expedient way to finance government deficits, large government deficits in general. And that takes us into this idea that if that is the case, then maybe the body which is in charge of managing the money supply needs to be independent of the government. And that takes us into the first key question that we raised at the start of this session, asking why does a central bank need to be independent, right? The more independent a central bank is, the more better able it is to resist political pressures. Okay, so that's in its original constitution, the Federal Reserve was incorporated as an independent body because this literature was well known, and it makes sense, right? You reduce this moral hazard problem where governments have an incentive to print more money in order to finance social services that they need to provide, but without raising tax revenues or cutting back on their spending. And if you do that too much for too long, then you might have a problem on your hands where the economy enters into a hyperinflationary spiral, and then you lose all confidence in that money, and then your credibility and the economy begins to crater. The critics, obviously, of the Fed's independence, and there's some vocal critics of the Fed's independence. Again, if you follow politics closely enough, Ron Paul and his son Rand Paul are very fierce vocal critics of Fed's independence because they claim that the Federal Reserve is, at the end of the day, managing the US economy and needs to be answerable to the stewards of the economy, who are the politicians, right? So their argument is that too much Fed autonomy makes it too powerful, and because it's independent, it's not answerable to anybody else in the economy, and that might be a problem. Yeah. Now we'll talk about it towards the closing of this uh, course about the Federal Reserve and where we might come down on this debate. That's the argument. I think I've already tipped my hand as to which side of the argument I lean on, but at the end of the course, I'll talk about the Federal Reserve and why I do think that the Federal Reserve's independence needs to be maintained. Okay, and just to give you a flavor of what that looks like, here's a brief illustration that makes this point for you. So here on the x-axis, we are measuring an index of central bank independence. On the y-axis, we are measuring average inflation rate between 1955 to 1988. What you see here is that the New Zealand Fed, which is not on the index of its central bank independence, doesn't rank very highly. The lower the central bank's independence is, the higher the inflation rate has been traditionally. And the more autonomous the central bank has been, so you can see that, like, if I try to fit like a line through that, it'll be like this, that there is an inverse relationship between how much inflation there is in the economy and the index of central bank independence. And straight away you have some measure of empirical evidence here that central bank independence is maybe crucial to making sure that inflation doesn't get out of hand, right? So that's where I'll stop for this week and this session. So if there's any questions, again, leave them in the comments below the video. See me in office hours. I hope this was clear. Um, Thanks for listening. I'll see you all in the next one. Bye-bye.